Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Wednesday, the 9th of April 2025, pardon me. Today will be Wednesday, the 9th of April 2025, and it's going to be a very interesting day today. So before we kickstart our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. Right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So as usual, before we kickstart today's Daily Dose of Market Insights, is very important because today will be the implementation day of the higher US reciprocal trade tariffs that the US administration wanted to target against EU, South Korea, Japan, and most importantly, China, with the deadline just ticking about less than an hour away as we are speaking. So let us have a quick recap what has taken shape yesterday first in terms of the news flow economic data release, and as well as their impact on the intraday movement on the broad-based cross asset classes. So let's start with the US market first over here. So the US market has a rather very dramatic movement yesterday again. But this shouldn't become as a major surprise for those who followed my Daily Dose of Market Insights, because I do highlight that yesterday that we do expect a kind of a dead cat bounce or a corrective mean reversion counter trend corrective rally within its medium term downtrend phase that is still intact. And that rally indeed takes shape, but it didn't so-called hit our desired short-term intraday resistance just by a fair bit, which I highlighted in yesterday's Daily Dose. So at the start of the US session yesterday, we talked about the cash market opened session. The major US stock indices, most of them rallied by 4 to 5%, 4 to 5% at the open, but due to this positive news flow coming out from the Trump administration, stating that Bissett is one of the key cabinet ministers in Trump administration, which is the Treasury Secretary. He said that there could be a good deals potential between some of the traditional US airlines, potentially South Korea over here. So that actually causes the US stock market to rally. Then, but however, this rally was rather short-lived, and thereafter it tumbled. It closed in the red yesterday in all the four major US stock indices. So the SPX is down by negative 1.6%. The worst hit was the higher beta Nasdaq 100 that is centered more on the growth-oriented mega cap technology stocks, down by negative close to negative 2%, to be precise, negative 1.95%. The Dow Jones down negative 0.84%, and the worst hit was the small cap Russell 2000, because of the at the end of the day, there's a big risk to the US economy that they may hit by this stagflationary environment, where i.e. a slower growth, higher interest rate, and the Fed's hands are pretty much tied to jumpstart the US economy by enacting higher of more aggressive interest rate cut cycle, which they are able to do so in previous crises. All right, but their hands are pretty much tied at this moment because of this stagflation risk upcoming from this trade war, not even between China and even versus the rest of the world. All right, so the Russell is being hit the worst by negative 2.7%, because the fact that the component stock in the Russell 2000 are pretty much dependent on the revenue flow tying directly to the state of the US economy, which is potentially facing stagflation, all right, going forward. Okay, so with that, the key big news of that why also the market slide is because of this ongoing intensification between US and China, because Trump himself was pretty much annoyed that Chinese leadership hasn't given him a call to negotiate any trade deal, whereas the China top leadership has decided to actually do tit for tat measures by slapping 34% tariffs on US goods heading into China, and that also potentially covers intellectual property rights as well. So i.e. Apple products will get hit. potentially also a company is operating in China may get hit, as well as particularly Tesla over here. So what we see over here is that Trump tariffs. So US actually now move forward. They confirm with 104% tariffs on China. That means, i.e., on top of the earlier 20% that is being slapped earlier at the start of this month, then followed by last week Liberation Day, where Trump actually introduced another 34% tariffs. And yesterday, Trump made a confirmation that he will slap additional 50% tariffs on China products heading into US. So a total of 104% tariffs on China, that is China products heading to US, that is way above that US China trade war 1.0 that was previously ignited in 2018. So the date of negotiation between US and China is getting very slim. Why? Because this 104% so-called implementation date, in fact, is just 1 hour away from now as you are speaking. Let me share with you. Yeah, so it will take effect, okay, on China. These steep new duties on China and 184 other US trading partners. That means that including Japan, South Korea, EU, at 12 a.m. Eastern time on Wednesday. So in Singapore time, that will be 12:01 p.m. So that's about close to about and less than about 55 minutes more from now as you are speaking. All right. So pretty much of a key event for today that could actually dramatically do two-way volatility swing. So later I'll share with you what are the key levels to watch on the major cross asset classes. And because of this 104% we call it tariffs, 104% tariffs on China products heading into US, and China does not want to back down, that potentially actually hurt oil prices. So if you look at WTI crude oil price, it's actually plummeted by 4% over here, all right, and broke below the previous minor swing low that was being formed on Monday, and now trading below the 60 level, psychological level on West Texas crude oil. And very interestingly over here is that we start to see the dollar strengthening against the so-called, give me a minute, okay, now April, the dollar continues to strengthen against the high beta currency, which is the Aussie dollar. So the Aussie dollar is the weakest among the major G10 currency pair. So the dollar is now having a gain of 4.6% based on the 5-day rolling performance basis. So later I'll touch on the technical configuration chart on the Aussie dollar. It seems to us that it's still trapped inside this minor sideways range that could last until today again, because it managed to survive at our short-term pivotal support level as we are speaking right now, and stage a bounce off that support level. All right, so perhaps this minor corrective rebound movement on the Aussie dollar has yet ended, which I highlighted earlier in my daily dose on Monday. So I'll touch on more later on the Aussie dollar. But what's interesting over here is that we start to see a rather mixed environment between the dollar major pair. So the one that is getting the most beneficiary out of it, that means dollar is the weakest against the safe haven currency, the yen, and as well as the Swiss franc. And most importantly, the dollar yen, yesterday we flipped back to a intraday bearish bias because we really hit our mean reversion corrective rebound resistance level much earlier on Monday, and yesterday it slid down as intended, and also being supported by this ongoing trade tariffs wars between US and China that may intensify in the coming days, and that potentially benefited the safe haven currency, which is the yen and the Swiss franc. So later I'll share with you right after the implementation at 12:01 p.m. Singapore time on the higher reciprocal US trade tariffs, we call it duties against China and the other 184 countries. There will be an important event 2 hours later. Later I'll share you what is this event at the end of today's daily dose when I cover the third segment that could impact the movement of the dollar yen. All right, so net overall what I could see is dollar strength is still strengthening, at least against the Aussie and the Kiwi over here, but however the dollar is weakening against the yen and the Swiss franc. All right, from here, and also at some extent against the euro as well, because of potentially there could be we call it further flows of funds out from US. from the US equity market, all right, because of yesterday's dramatic bearish reversal on the major US stock indices. All right, so rather a mixed bag, I would say, on the FX market at this moment in the short term nature. Okay, so gold price continues to hold firm. So if you look at the gold price, is up in Asia session today by close to about, I think, 1% or so. So let me very quickly share your gold price. Yeah, gold price is up by 0.85%. All right, 0.85 at one point in time it hit 1% in today's Asia session. So gold still holding rather firm at the 50-day moving average. That's acting as a support at around 2,940 on the XAU/USD over here. So those who recall my daily dose yesterday, we flipped to an intraday. We have an intraday bullish bias for a potential counter trend rebound after a Elliott wave 5 wave down since 3 days ago. All right, because of that, then we actually have a counter trend rebound purely based on a technical factor. All right, so later I'll touch on the levels again, the key levels to watch out for today's gold intraday technical outlook, and as well as the key levels to watch. All right, and what's very interesting over here is that we know that China is being hit by 104%, and with that, yesterday's the offshore yuan, which is also one of the tool that the Chinese top policymaker used to actually kind of massage to actually have a lesser effect on the so-called the real economy. So previously, yesterday, you see the offshore yuan. This is not the onshore yuan, it's the offshore yuan, because in China FX market is pretty unique. There's the onshore and offshore. So the offshore yuan is being quoted as CNH. The onshore is CNY. So the CNH are available to much more international flows in terms of speculator and for hedging purposes. So the offshore yuan yesterday actually pierced up and do a fresh all-time high, breaking above the major resistance of October 2022 at 7.3750. All right, so that's about the 7.4 level. And in today's Asia session at the opening, the PBOC, which is the Central Bank of China, did a lower fixing and try to actually soften the rally of the dollar against the CNH. So the reason why over here is that initially the market, the thing rallied over here during the US session. So it actually initially expected the so-called the what you call it, the PBOC to actually have a much more dovish stance, much more aggressively to weaken the Chinese yuan. So that is in fact so-called put in a way that it will actually negate the higher tariffs that's being on Chinese products heading into the US economy. But nonetheless, do not forget over here is that China don't trade to US alone, they trade against the rest of the world. And if the dollar continues to weaken against the rest of the world, let's say against the euro currency, the euro CNH rate may be at a stronger higher level. So that particular we call it yuan weakness may not be so persistent against the dollar. That's why we see the dollar yen now falling a fair bit right now by forming a bearish candle, and so part of potential PBOC intervention as well to soften the yesterday's we call it a spike up of the dollar against the yuan. So they do not, the PBOC or the top policy makers does not want the Chinese yuan to weaken so dramatically, and also by weaken too dramatically, it will cause capital outflows from their equity market. So that's why what you could see over here is that because of this deliberate, we call it massaging of the yen weakness by PBOC in today's Asia session, we start to see the Hang Seng Index actually recovered. So you see the Hang Seng Index over here, previously there was actually, this is today's Asia session, it opened with a gap down, all right, over here, yesterday's close, it gapped down, it hit a low of about 4% intraday loss, and this intraday loss has now started to trim up to only negative 1%, and it's trying to actually fight back above the key 200-day moving average, all right, which is a 19,700 level. And this is the Hang Seng Index, and that one that is more sensitive to growth will be I would say it's a high beta Hang Seng Index, one of the higher beta Hang Seng indices, which is the Hang Seng Tech Index. So this Hang Seng Tech Index comprises of the China big tech stocks, which is one of the what I call a much more we call it index that is more centered, growth centric over here. So what you could see over here is that very important is that same thing, it gapped down in today's Asia session, right, by -6%, because it's a higher beta, so it moved at a higher magnitude. So from this -6% intraday, and because of that massaging by PBOC to kind of reduce the magnitude of the yuan weakness against the dollar, the Hang Seng Index managed to trim its intraday losses, as now only by now is losing about -1%. So very interesting over here. It seems to me that based on purely the price action on the intermarket movement of the Hang Seng Index and the dollar CNH, China top policy makers, with the help of potentially state funds and as well as China state funds and PBOC, which is China Central Bank, is out there in the market right now to smoothen the any negative feedback loop that could be impacted on the China related financial instrument, as the clock ticks now closer to 12:01 p.m., which is the implementation of Trump's more aggressive 104% tariffs on Chinese products. So later I'll touch on what are the key levels to look out for on the Hong Kong 33, which is the Hang Seng Index in OANDA's platform, representing OANDA's platform representing the Hang Seng Index. All right, so that covers the first. Okay, before talking about first segment, let's look at what happened in the US fixed income market. All right, so we know that previously there's a series of US Federal Reserve officials coming up to talk to actually refute any rumors saying that the Fed is about to come in and step in and ignite an interest rate cut cycle because of the dramatic fall in the US stock market. But however, this slew of Federal Reserve officials that have spoken yesterday and last week, stating that they are more concerned about these trade tariffs have on the real economy that could actually lead to sticky inflation. So they are no more concerned about sticky inflation rather than growth risks that could be impacted or by the this we call it higher, more aggressive trade tariffs policy that's being we call it undertaken by the US White House administration. And because of this, that actually led the 10-year US Treasury to bounce back rather dramatically yesterday. All right, so there's a big V-shaped reversal on the 10-year US Treasury yield, back above in the last three sessions. Previously it pierced below 4%, now it's trading at 4.41%, and technically it managed to pierce above the 200-day, 20 and the 50-day moving average. Okay, so this is the 10-year US Treasury yield, so indicating that cost of funding environment in the US still remains on the high side because of the unreluctant of the Fed to actually kickstart an aggressive interest rate cut cycle, despite the fact that we start to see we call it pronounced weakness at the start of this month in the US stock market, and this form of weakness is falling in terms of a faster pace over here. So the Fed doesn't give this rather dovish guidance at this juncture. So because of this, that also led to a sell-off in the US stock market yesterday as well, based on this intermarket relationship. And most importantly, let's look at the CME Fed Watch 2. So based on this latest Fed speak coming out from Federal Reserve officials yesterday and as well as a couple of days ago, there is adjustment in the CME Fed Watch 2. The CME Fed Watch 2 is actually a mathematical tool they come up by CME. What they do is they actually look at the Fed funds futures market, traders in the Fed funds futures market, how they actually trade the futures contract from the near term to the forward looking to the future term. Because futures contract, there are various month of expiry, and from there CME Fed Watch did a model, it comes with a model, and they calculate the expectation in the market participants of the Fed funds futures market, how they price the Fed monetary policy decision outcome going forward. So based on the latest one at 7th of May, the market has a 50-50% chance that the Fed will actually cut or hold. All right, so current rate is at 4.25%. All right, so 50% chance, it's 50. Yeah, okay. So but now, how about other months down the road, like in July, June, August? So previously, last week, the Fed funds futures traders, they actually priced in 3 to 4 cuts that could take place this year before this year ends, right? But after a slew of Federal Reserve officials that come out to speak to actually soften the tone that, hey, we are not turning so dovish yet because we are watching out for inflationary risk in the US, that actually changed the aggregated probability in the Fed funds futures contract, not even the current month and in future months as well. So we start to see is that the next cut at a higher rate will cut, higher probability, which is 58%, will come in the June meeting to cut over here. All right. Then thereafter, it will remain the same. It was now is 4.25%. All right. And at the December 74%. So 74% probability that the Fed fund rate will end at 3.25%, right? 3.25%. All right. So what we could see over here is that very interestingly, right, even though the 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 the, the, the Fed funds futures contract, right, at 58%, 51% in the month of June and July. That means this month of June and July, these two cut, right, is like a coin toss. But by the end of the year, the market participant is still expecting a high chance, because this is more than 60% now, which is at 74% on the last FOMC meeting in 2025, which is 10th of December 2025, at a probability of 74% chance that the Fed funds rate will end 2025, the year of 25, at 3.25%. So you get 4.25% minus 3.25%. So that is a 1% reduction. So every time the Fed funds move, right, is they will cut by 25%, 25 basis point. So what the market now is expecting, is still expecting, right, a pricing of a 4 interest rate cut, which is rather aggressive over here. Okay, so there could be a potential chance that the Fed funds futures contract is being mispriced at this moment by the Fed funds futures traders, the shorter term traders over here, that is going against the movement of the longer term 10-year US Treasury yield, right? So something to look out for as well from a longer term perspective, stating that the too much, we call it dovishness, is being priced in by the CME Fed Watch 2, anticipating a much more dovish Fed. But however, the longer term 10-year US Treasury yield is not saying so. Right, so something to take note of. Okay, so with that, now let us now touch on immediately the second segment of today's daily dose, which is the intraday technical outlook. All right, on the various broad-based cross asset classes. So with that, let us now expand my screen so that you guys could actually have a better view of the charts. Yeah. Okay, good. The screen should be expanded. All right. So now let us start with the FX market first. Right, the euro dollar. So the euro dollar, since Monday, we do have a bullish bias, and this bullish bias continues to take hold. As we are speaking right now, it managed to break above this minor descending trend line that I drew from the high of last Thursday over here. Let me draw a proper one. Right, it broke out. So what you could see now is that this price action now has really tended to have it already broke out above the 1.020 level, the first resistance that we highlighted yesterday as well. So with that, because of this bullish breakout, I will have a tightened short-term pivotal support for today in terms of a better risk management perspective. So I'll put it very close to the pullback line of this former minor descending trend line, now turns into a pullback resistance, which is at 1.0950. All right, let me put it in writing over here. Okay, let be writing for a while. All right, so allow me a couple of seconds, okay, to get it sorted out, because sometimes it's just hang while I'm speaking. Yeah, let me change it. Okay, good. 1.0950. Okay, let me put it in writing. Oops. $1.0950. Okay, so this will be my short-term pivot. Okay, so this will be just okay. Let me summarize everything. All right, because of this bullish breakout that we are seeing right now, and it really cleared above the first resistance at 1.1020, so we'll still maintain that intraday bullish bias on the euro dollar for today, but with adjusted tightened short-term pivotal support for today at 1.0950, which is so the pullback line of this former minor descending trend line now turns into a pullback support level. Next two resistance level to watch on the intraday basis will be 110.80 followed by 111.50, which is the long-term descending channel upper boundary from Jan 2008 high. It's very important because if it has a daily close above 111.50, that means i.e. we are now starting to see a much more pronounced multi-week dollar weakness. All right, because the euro dollar is a major, we call it a highest weightage currency in the US dollar index, US dollar index, which has a kind of a significant feedback loop to the dollar sentiment. However, if price action suddenly did a dramatic reversal and have an hourly close below 1.0950, then today's intraday bullish bias will be negated to see a retest at the 20-day moving average that is acting as a support level at 1.0860 as we are speaking right now. Only a breakdown below 1.0860 will trigger a much more, we call it extended minor corrective decline scenario for today, exposing the next near-term support level at 1.0770/1.0730, which confluence with the 200-day moving average. So in a nutshell, still maintain that intraday bullish bias on the euro dollar, looking at 1.0950 short-term pivotal support to maintain this bullish bias, and resistance level to watch will be 110.80 followed by 111.50. So 111.50 is also very important because this is a major resistance on the euro dollar, because it's the upper limit of this long-term circular descending channel that is still in place since January 2008 high. So if we have a daily close above this 111.50 level for today, it could actually imply that potentially we may start to see a much more pronounced dollar weakness going forward that could last from multi-week perspective and even multi-month. All right, because the euro is highest weightage currency in the US dollar index that potentially could have a significant psychological impact and influence in the dollar. All right, so that's for the euro dollar. Up next will be the sterling dollar. So the sterling dollar is trending slowly upwards, but at a slower pace than the euro. But nevertheless, it continues to actually flash a series of higher low right above our pivotal support that we highlighted at the start of this week, 127.25/127 figure level. So it hasn't actually cleared above the 200-day moving average yet at 1.2830. So I don't want to tighten my pivotal support to be so tight, to be at 1.2770, because just in case of a whipsaw. So I still use the base of this potential minor bottoming formation at potential higher low formation at this around the 50-day moving average as well. 1.2725 figure will still be my short-term pivotal support level, still maintaining my intraday bullish bias supported by a series of higher low that is continuing to play out in the hourly RSI, indicating upside momentum still remains intact on the short-term basis as it hasn't hit the overbought region yet. So two near resistance level to watch after 2830 will be at 1.2925 followed by 1.2965. Only a bearish reversal and hourly close below 1.27 figure will invalidate today's intraday bullish bias on the sterling dollar to expose the next near-term support level at 1.2620 followed by 1.2565. Okay, up next, very interestingly, will be the Aussie dollar. So like I mentioned, the Aussie dollar managed to actually still survive in today's sell-off at early Asia session sell-off at 59.30/59.20 pivotal support that we have since Monday. So potentially this counter trend kind of rebound phase could still be intact because of the bullish hammer that's being formed right at the test at the 59.30, 59.20, and the RSI managed to actually shape a bounce off this pullback, we call it support line as well. So with that, given that of this kind of a positive element, at least is being seen on the hourly time frame chart, that means there could be still some form of residual corrective bounce that is still left on the Aussie dollar. So with that, I'll still watching the 59.30/59.20 short-term pivotal support level to maintain this residual corrective rebound sequence, a minor one. With resistance level to watch will be at 60.60/60.90 that was being tested on yesterday, and as well as Monday that it can't break above 60.90. Only a breakout above 60.90 may see this residual corrective rebound phase on the minor time frame extended to expose the next near-term resistance level at 61.40, which is the Fibo retracement of 50%. All right. So, however, if we start to see a dramatic sell-off and hourly close below 59.20, this residual corrective rebound sequence will be invalidated, and what we see is that the bears will take hold again to actually kickstart another round of impulsive downward sequence, exposing the next near-term support in first step at 58.70/58.05. So in a nutshell, still using the 59.30, 59.20 short-term pivotal support for a potential residual minor corrective rebound phase that may still be in place in today's intraday session. All right, so that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen yesterday slide down as expected, where we flipped to a intraday bearish bias after hitting 148.15, which is our minor counter trend rebound resistance. Price action has really hit the first support level at 146.20 and broken down below it in yesterday's US session. So this will be my first intermediate resistance level to watch at 146.60, given that the RSI is now coming to the oversold level. So there could be some form of minor bounce as we head into the US session, and as we head into the European session today, and also due to this key risk event that I'll share with you that is taking shape at around 2 p.m. Singapore time that could impact the dollar yen. All right, so I don't want to tighten the pivotal resistance to be so tight at 146.60. I'll put it adjusted one slightly lower at 148.15. So that was the inverted V shape, the rejection of it at 148.15 before kickstarting this ongoing minor slide as we are seeing. So first support level to watch will be 14450/14480. So 14480, very important level. A breakdown below this level could actually potentially see a much more pronounced dollar yen weakness from a multi-week perspective and even a multi-month perspective. But in first step, after a breakdown below 14480, the next near-term support level to watch on an intraday basis remains at 14390/60. Right, which is also the 0.618 Fibo extension taken from the high minor swing high of 28th of March, and also the lower boundary of this ongoing medium-term descending channel that is in place since 8th of January. So I want to mention why 14480 is very important. It's a major support, and the daily close below it has significant implication on the dollar yen, because if we go to the daily time frame chart, this 14480 is in fact the major ascending wedge trend line that is in place since 2 years ago, which is in January 2023. So if you have an hourly close, if you have a daily close, that means by the end of today's US session, you have a daily close below 144.80. It implies a major bearish breakdown from this ascending wedge, which implies a potential multi-week dollar yen to multi-month dollar yen weakness. All right, so that's have a significant implication, all right, on the FX market as well. So on a near-term basis for today, we are still using the next support at 144.80 will be at 14390/60 on an intraday basis. However, if price action suddenly dramatically break out above 148.15 level with an hourly close above it, then today's intraday bearish bias will be invalidated to transform the dollar yen back into a minor mean reversion corrective rebound phase again, exposing 14910, which is the 20-day moving average. Above it may see 150.30 next, which is the 50-day moving average acting as a resistance, and as well as the upper limit of this medium term descending channel. All right, so i.e. in a nutshell, using a slightly adjusted lower short-term pivotal resistance level on the dollar yen for today at 148.15 to maintain the intraday bearish bias. All right, so that sum up the intraday technical outlook on the major dollar pair. So now let us turn our focus to the major stock indices, starting with the Hong Kong 33 over here. So based on the Hong Kong 33 representing the Hang Seng Index, so I actually explained that the Hang Seng Index managed to actually trim off earlier intraday losses because of potential intervention from various China-related government bodies over here. So it managed to survive the pivotal support after a test of it at 19,290. So right now it attempting to actually trade back above the 200-day moving average, where it got rejected as you are speaking right now at 19,900 level. So I'll be watching this level very closely, 19,900 level. So breakout above 19,900 level, at least an hourly close above it, potentially could revive at least a we call it a mean reversion rebound scenario on the Hong Kong 33 to expose the next near-term resistance level. Okay, let me put a type over here. At 20,400. On an intraday basis, followed by 21,004, which is the last this Monday gap down high, this Monday intraday session high after the gap down, slash 21,300, right, which is the former minor swing low of 11 of February. And as well, if you do the Fibo retracement of this sell off, okay, that correspond closely to the 50% as well. All right, so no change, still watching the 19,290 short-term pivotal support, but price action got to break out fast above 19,900 to increase the probability of this potential mean reversion rebound in the first step, with two intermediate resistance level to watch on the intraday basis, 20,400 followed by 21,040 slash 21,300. However, if the price action starts to inch down below 19,290, then the bears will take a firmer hold in the Hong Kong 33 to expose the next support level at 18,955 slash 18,600 level. Below it is 18,235 slash 18,120 next. So that's for the Hong Kong 33. Next up will be the Nikkei 225. So the Nikkei 225, we do have a counter trend rebound phase scenario yesterday. The rebound take shape and hit our resistance level 33,360, almost hit the second one at 34,080, but can't hit it and shape that bearish reversal. So what we could see is that the hourly RSI has started to break down, has broken down below a key parallel ascending trendline support, indicating the return of downside momentum on the Japan 225 over here. With that, the hourly RSI hasn't hit the oversold region yet. So with that, we will flip back to a intraday bearish bias for today. Potentially the bears may have already taken a foothold in the Japan 225, using 33,360 as my short-term pivotal support level as price action continues to play with the 31,840. So that was our pivotal support yesterday, right? It can't break down during the start of today's Asia session. So because it haven't broken down this level yet, I don't want to have a very tight short-term pivotal resistance level. So we're still maintaining at 33,360. But however, thereafter, if it's managed to stage hourly close below 33,840, then we could have tighten our short-term pivotal resistance level to 32,700. All right, 32,700. So for now, still use 33,360 as my short-term pivotal resistance level. Flip to a intraday bearish bias. Next support level to watch will be this Monday minus swing low, 30,390. Below it exposed 29,295 slash 28,960 next. So that's for the Japan 225 representing the Nikkei 225. Next up will be the Germany 30 representing the German DAX. So this German DAX also try to shape that bullish, we call it a counter trend rebound scenario. Didn't hit our resistance level before trading that backwards and reintegrate below the 200-day moving average, because we have the counter trend rebound resistance at 20,700, 720. So with that, the first resistance level to watch will be this 200-day moving average now turns into a pullback resistance at 19,970. But I don't want to put it so tight at 19,970 for my short-term pivotal resistance level, just in case of any whipsaw, given the fact that the European market hasn't yet opened yet at this juncture. So there's lower liquidity in this German 30 CFD index. So with that, still using 20,720. I'll be using the higher level 20,720 as my short-term pivotal resistance level. Flip to a intraday bearish bias for the German 30. First support level to watch 18,935, which was Monday swing low area. A breakdown below it exposes 18,255 next. However, if price action starts to do a reversal back above 20,720, then this mean reversion rebound scenario may continue to expose the next near-term resistance next at 21,100, followed by 21,310 slash 21,540. So i.e., in a nutshell, given that he has reintegrated back below the 200-day moving average, very likely the intraday rebound has really, the short-term minor counter trend rebound may have ended. So we will flip to an intraday bearish bias for today on the German 30 using 20,720 as my short-term pivotal resistance level. Right, next up will be the major US stock indices representing the, firstly will be the US Wall Street 30, representing the Dow Jones Industrial Average. So Dow Jones Industrial Average hit our resistance, our mean reversion rebound level at 39,130. It hit this level here before reintegrating back below it. And what we could see over here is that the RSI itself has almost coming close to the oversold level. So there could be some sign of a bounce after a test at around the 36,790, 36,400 support level. So after here, you may see a bit of bounce. So bounce potential first resistance will be at 37,770. So for now, I don't put I will use a higher level as my pivotal resistance level, which is 38,815, which is this previously this was the minor swing high earlier on Monday. It broke out, can't maintain that swing high and reintegrate back below it. So this is considered as a failure intraday breakout from this long tail candle previously. So this have a significant psychological impact or a psychological effect, I would say. So using this level as my short-term pivotal resistance level for today, 38,815, we'll flip to a intraday bearish bias again on the US Wall Street 30 as this minor counter trend rebound may have already ended yesterday. Next support level to watch after 36,400 will be at 35,755 slash 465, followed by 34,800 slash 705, which is the 0.674 Fibo extension, taking from the high of yesterday's intraday high. All right, only hourly close and a push up above 38,815 will invalidate today's intraday bearish bias to revive back another leg of mean reversion counter trend rebound scenario, exposing the next intermediate resistance at 39,650 slash 870, followed by 40,440. So in a nutshell, we'll be flipping back to a intraday bearish bias using 38,815 on the short-term pivotal resistance on the US Wall Street 30. All right, lastly will be the Nasdaq 100. So the Nasdaq 100 also staged a bearish, we call it a reversal as well, after coming close to that resistance zone that we highlighted yesterday for our mean reversion rebound, 18,320 slash 570, clearly breaking down below this bearish flag formation. So pullback of the bearish flag over here will be at 17,407 as it's fast approach the 16,590, 16,535 minor swing low of last Monday. Right, so upon hitting this level, there may be some signs of a bounce taking shape because the RSI is coming close to the oversold level. So first resistance to watch is at 17,400 level. So I'll be using 17,880, which is this minor swing high of last Monday. Yesterday there's a breakout, but this breakout attempts to be a failure breakout as price action reintegrate with a bearish hourly candlestick thereafter. All right, so this level here could have a significant psychological effect as well on the Nasdaq 100. So with that, using 17,880 short-term pivotal resistance on the Nasdaq 100, we'll flip back to an intraday bearish bias after 16,335 may expose the next near-term support level at 15,850 slash 770, followed by 15,295 next. Only an hourly close and a push up above 17,880 will invalidate today's intraday bearish bias on the Nasdaq 100 to kickstart another leg of mean reversion rebound scenario, exposing the next resistance level at 18,320 slash 570, followed by 19,020, which is also correspond to the downward sloping 20-day moving average. So i.e., in a nutshell, using 17,880 short-term pivotal resistance, we'll flip back to a intraday bearish bias on the Nasdaq 100. All right, so that's also sum up the intraday technical outlook on the major stock indices. So let us now turn our attention to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, we do mention that because gold has a 5-wave down already from its all-time high in 3rd of April, 1, 2, 3, 4, 5. So after 5-wave down from an elliott wave perspective, and it ended right exactly at a bunch of support level that's been defined graphically and mathematically with a 50-day moving average, and also there's this bullish divergence that was being flashed out yesterday. Hourly RSI now also has managed to break out from a descending former descending trend line. Oops. Okay, indicating bullish momentum still remains intact, at least on a short-term basis. So there could be ABC retracement after this 5-wave down on the elliott wave perspective for gold XAU/USD. So with that supporting technical factors, we will still maintain our intraday bullish bias on gold XAU/USD, but we'll use a slightly higher pivotal support for today, which is close to the minor swing low of yesterday at 2,955. So using 2,955 short-term pivotal support level, maintain the intraday bullish bias on gold XAU/USD. Resistance level to watch on the intraday basis, 30.40 followed by 30.60. Next, all right, these are the two levels to watch out for. Above 30.60, may see 30.87 coming in. 30.87. All right, so 30.87 is also this congestion area here from 4th of April, last Friday, before the sell-off, before that dramatic sell-off. And also if you do the 5-wave down Fibo retracement, that confluence with the golden ratio of 61.8% as well. However, if price action dramatically have a reversal below 2,955, today's intraday bullish bias will be invalidated to kickstart the continuation of this corrective decline sequence, exposing the next near-term support level at 2,936, followed by 2,906 and even 2,880 next. So that's good for gold XAU/USD. So based on the still ongoing short-term intraday positive technical factors, we will have adjusted short-term pivotal support at 2,955 for gold XAU/USD and maintain its current intraday bullish bias. All right, next up, lastly, will be the West Texas crude oil. So the West Texas crude oil plummeted below the 60.50 level. So with that, very likely the counter trend rebound has really ended. All right, so with that, we will flip back to an intraday bearish bias for a continuation of this impulsive downward sequence over here, using 60.50 as my short-term pivotal resistance level, which is the former minor low now turns into a pullback resistance, and also the upper limit of this ongoing minor descending channel from the high of 3rd of April. So we'll flip back to an intraday bearish bias. Next near-term support level to watch, 54.50/53.80. Breakdown below it may expose 51.30/50.65. Only an hourly close and a breakup above 60.50 will revive back that counter trend rebound scenario again and invalidate today's intraday bearish bias to expose the next near-term support level at 62.50/63.36. Above it may see 65.40 coming in next. So i.e., in a nutshell, flipping to an intraday bearish bias for today for West Texas oil, using 60.50 as my short-term pivotal resistance level. All right, so excuse me. So that sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's take a look at the economic calendar. What are the key event and data to look out for, other than around I would say that 10 more minutes from now, or I would say 11 more minutes from now, before the effective we call it start of the higher US reciprocal tariffs on China and against other countries. So like I mentioned earlier on, one data to look out for, very important, will be the dollar yen. Will be at 1 p.m. Singapore time, which is, give me a minute, sorry, today will be Wednesday. Yeah, correct. Okay, let me expand my screen. Okay, 1 p.m. Singapore time, consumer confidence for Japan. Market is expecting a slight dip to 34.7 from 35 that was printed in February. And the more important one is Bank of Japan Governor Yuda speaking. He will have a speech at 2:15 p.m. Singapore time. So that could impact the dollar yen rate as well. So then thereafter will be a quiet US session until we start to see EIA. So there's this EIA weekly crude oil stockpile change that could impact the WTI crude oil movement. So that's 10:30 p.m. Singapore time. And thereafter, will be a quiet US session, and we have the release of the FOMC minutes at 2 a.m. Singapore time. All right. So then in early Asia session, that could another data that could impact the dollar yen rate or and even the Nikkei 225 is at 7:50 a.m. tomorrow Singapore time before the start of our daily dose, which is Japan PPI data. All right. Market participant is expecting a slight dip to 3.9% year on year from 4% that was printed in the month of February. All right. So with that, that sum up today's daily dose of market insights. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.